A very good morning to all the attendees of the webinar. A very warm welcome to all the people who have joined in, taken out some precious time from their busy schedule and getting some knowledge and information about the current topic that is going to be discussed today. I would like to introduce myself. My name is Manoj Phadke. I represent the Financial Hospital corporate team. I work in respect with as a corporate relationship manager. Our roles and responsibilities are pretty defined in terms of what we do. We engage in certain webinars. We engage certain corporate connections with our webinars, which will give you information related to the financial aspects of certain areas, specifically related to investments, your financial planning, tax solutions. So that's all about me. I will tell you a little bit more about Financial Hospital. And now, Financial Hospital has been in the market for the last 24 hours, for the last 2004, since 2004. And Financial Hospital has successfully serviced each and every client, whether it is from India or abroad. So we have catered to customers specifically for their financial planning needs, tax planning or investment planning into equity, debt, or any alternate category that our customers have an interest into. Plus, our team is also backed by a very strong research and latest economic trends, and we are always ready to serve our beloved investors any queries or needs that they may have. So we have a team which comprises of CAs, which is chartered accountants, MBAs, and certified financial planners who have thorough knowledge about the product, the markets, and do have strong leadership skills as well. So that is all about Financial Hospital. Also, let you know that Financial Hospital is a fee-based advisory firm, and we specialize services like financial planning, investment planning, tax planning, retirement planning solutions, and all end-to-end financial planning solutions taken up in a comprehensive manner. And the speaker for today's webinar would be Mr. Lavish Bhambhani. Mr. Lavish Bhambhani has been working with Financial Hospital as in terms of a senior financial planner for the last 5+ years. To let you know about a little bit about Lavish, he has excelled exceedingly well over the last 5 years in financial planning, working closely with clients to achieve their financial goals. He's analytically sound at interpreting financial data, making recommendations, and implementing risk management strategies that drive profitable and sustainable financial advantage. He's able to reach a large audience in terms of his research skills in equity and debt markets to determine investment opportunities while developing and validating soundness of models to achieve a desired rate of interest. So, returns on investment, I should say. And obviously, his hobbies include, as far as I know him very well, working with him closely for the last 3 odd years. He loves his soccer. He loves his cricket. He's very actively participant in as a sports enthusiast that we can call him. So I would now be handing over the reins across to Mr. Lavish. Now, let me tell you a bit about the presentation flow. The presentation will go in such a way that Lavish will take over from here on, and post which after his presentation is over, we will have a question and answer session wherein based on the topic that he's presented, if you have any questions related to the to the presentation, you can definitely ask, and we'll be more than happy to assist all the questions that you may have related to the topic. So I would now hand over the reins across to Mr. Lavish, who will be explaining everything in detail. Lavish, could you please take over?
Thank you so much for the introduction, Manoj. Hi, everyone. Very good morning. Hope everyone is doing well with these troubled times. Yes, so I would be talking about the entire tax regime today, specifically for the new and the old regime that the government has announced. And so I'm going to be starting to share my screen with you as well. Just give me a minute, please. There we go. I hope
Yes, Lavish, it
everyone
is
can.
visible. It is visible. Please go ahead. Thanks.
So, first of all, again, thank you everyone for being here. And now let's talk about one topic where everyone is a little confused from what we've seen in the past couple of months, where people have to make a decision whether to go for the old tax regime or the new tax regime. First of all, what is tax? Right? Tax is something that everyone, whether we like it or not, we have to pay, especially the service class people, where your tax is deducted at source according to the data that you provide to your employer or the data that is given. And further we can always make a little bit of changes as to how we can increase our net take home salary by either investing into certain places or having our home loan things mentioned over there to your employer. So that's what we're going to discuss today. So now, diving right into it, this what is displayed in front of you is the new tax slabs which has been offered by the government. This is literally within one country itself. You have two options: either you want to stick with the old one or the new one, right? So over here, if you go to see, let's talk about the old tax regime first. Um, it was basic from 0 to 2.5 lakh rupees was zero tax liability. 2.5 lakh rupees to 5 lakh rupees is about 5% you'll be taxed on that amount. 5 lakhs to 10 lakh rupees is a 20% tax liability. Any income that you make above 10 lakh rupees was in the 30% tax liability. Okay. Now, in the new tax regime, it's changed a little bit. So it's up to 5 lakh rupees is zero. Well, the 5% earlier was, given an exemption for certain people earning only below 5 lakh rupees. But now in the new regime is also, it's nil itself. Now, from 5 lakh to 7.5 lakh rupees, you are going to be charged at a 10.4% return, 10.4% tax. Then from 7.5 to 10, 15%, so on and so forth. This is the new tax slab that has been, given you as an option. Okay. One different thing that has been offered by the government this time is that previously, whenever you used to receive any dividend, right, from equity shares that you owned by the companies that you own, they pay some dividends. Previously, the dividends were taxed from the company itself. Like, for example, if you had a company called X, they'd given you a dividend of say 1,000 rupees. The tax used to get cut from the source itself, that means from the company, and then handed down to you. Now, what's happened is that that company X is just going to give you that entire 1,000 rupees. That 1,000 rupees is going to be added into your income, and whatever slab that you fit in, that is the tax that you're going to pay on that dividend. Um, the government has given a bit of a levy on perquisite tax for salaried employees. If your contribution towards EPF, yours as well as the employer, NPS, superannuation, all of it, if it's together higher than what do you call it? It's higher than 7.5 lakh rupees in total in the full year. Then there's a tax levied on that as well. So this is specifically common for those people with their incomes above 80 lakhs or 1 CR in the full year. That's when these perquisites really increase, or people who have opted for a very high voluntary provident fund contribution. Now, in the new tax regime, you have options. Okay, like the ones that the government has previously offered you in terms of ATC, ATD, and all those medical uh, insurance covers that you can do, which we're obviously going to dive in details also in this presentation. But you have an option to choose whether you want to go for the old or for the new tax regime. So before we dive into the numbers, like what should I really do? One thing is certain, like one question that I've actually got asked a lot is that if I, for example, if I choose this tax, the new tax regime today, after what do you call it? The next year, if I want to switch out, then is that really possible? So it is possible if you are a normal salaried employee and salary individual, then yes, you can switch out, to the old or the new tax regime next year as well. But for individuals who have, and HUFs rather, who have, just HUF is a Hindu undivided family. So for these entities who have any sort of business income, then number one, in the previous year, you cannot go into the new tax regime, number one. And number two, further, if you choose for this financial year to go into the new tax regime having business income, then you will not be able to opt out of it. Okay, I'll tell you, I'll clear the air as to for you to make your decision whether you are in this or not, if you should go into the new tax regime or not. And on the right over here, you can see the similar rates as well, which was discussed in the previous slide as well, just to give you a perspective on the new tax regime percentages. Now, this slide is something that everyone would really find use in this. I'm sure it'll add value to you. This breaks down each and every component of what you do generally see in your salary slip. This will be the deciding factor for you whether or not to go to the old regime or the new regime, right? So now let's take. I'm going to do this simultaneously, the old and the new, just comparing it. Um, so before I dive into this basically shows you whether or not you can, if you have these components in your salary slip, in the new regime, can you claim this or not? As simple as that. Okay. So now, basic, obviously, there's no changes in that, so that's just a null part over there. Now, coming to HRA. HRA stands for House Rent Allowance. In the old tax regime, yes, you can claim your HRA subject to your paying rent into, you have a rent component that you're paying some rent in your structure, so to say. While in the new tax regime, you cannot claim any HRA benefit. Okay. Leave travel allowance, LTA. Yes. In the old tax regime, you could claim this exemption. This is in a block of 4 years, four years with a block of 2 years each, where you can claim it once every 2 years, leave travel allowance. Just a point over here, everyone, that you always have to keep, your boarding pass if you're traveling through flight, or if you're going into a, AC train, then you need to keep your tickets with you so that you can claim it with your HR. Because for them to, accept it during, your normally November, December, January time, when you have your time for proof submission, this is the document, or that the document that they do ask for. So be it for LTAs, remember to keep your boarding passes or your tickets from your train travels. And I've seen one question here usually is that if I'm going to places where trains are not reachable, or rather I'm taking a taxi and going to say Mumbai, Pune, so those are not really allowed. It's only if a place like from point A to point B, if an AC train goes there or any train facility goes there, then an AC train fare is applicable over here. Moving on to uniform allowance, traveling expenses, mobile expenses, internet, R&D helper. In the old tax regime, yes, these expenses can be claimed to reduce your taxable income. But in the new tax regime, no, it can't. When it comes to your annual bonuses, I hope everyone reaches their bonus, performance bonus and all, even in these hard times. But in the old or the new tax regime, they're not going to give you any exemption per se over here, because this is over and above your normal salary. Now, I hope everyone is aware of ATC contributions, where you can reduce your tax liability. I'll in fact dive into it in the next slide as well. But yes, in the old tax regime, you can make investments or contributions towards ATC. Under ATC, your contribution towards Provident Fund, your NPS, your insurance policies, which is coming later as well, tuition fees, those all, you can claim these exemptions in the old tax regime, but not in the new one. But it has a limit of 1.5 lakh rupees. So even if you contribute into these avenues for say 5 lakh rupees, but the amount that would be exempted or would be reduced from your taxable income would be only 1.5 lakh rupees. And I would add some value over here. Over and above 1.5 lakh rupees, there is a section known as ATCCD, or rather NPS, which you can contribute over and above 1.5 lakh rupees to a maximum of 50,000 rupees to reduce your taxation there as well. But this would be counted only in the old tax regime, not in the new one. A few companies contribute towards their employees' NPS, National Pension Scheme. This is, to be very honest, it's not very common in private companies, but if your company has it, that's very good. So till a limit of 1.5 as well, sorry, till a limit of 7.5 lakh rupees in the new tax regime is, acceptable in the new tax regime, while in the old tax regime is simply still in the 1.5 lakh rupees. Now, whoever has, a home that either they're living in or they're giving it out on rent, so this is for you. If you're staying in a self-occupied property and you're paying interest on that loan, then up till 2 lakh rupees you can reduce your taxable income. I'm sure you're aware of this. But to add value over here, if that same property is on your name as well as your wife's name, as in a joint name, then the interest that you can claim is 2 lakhs each. So 2 lakhs on your name as well as 2 lakhs on your spouse's name, or whoever, be it your mom, dad, whatever it is, you can claim another 2 lakhs on a, it's basically on basis on a PAN basis. So in your PAN, you can claim 2 lakh rupees for you. While in the new tax regime, sorry, this has been removed. You cannot claim this interest on housing loan over there. As I mentioned, insurance policies, tuition fees come under ATC. Old tax regime, yes. New tax regime, no, you cannot claim it. Medical insurance wise as well, you can claim it for your insurance premiums that you do pay, which I'm sure everyone right now would have reviewed in the last couple of weeks. Yes, just to point out that your normal medical insurance also covers if you contract the COVID-19, your normal medical insurance does cover the expenses from it, and that's why it's very important to have medical insurance over and above your company as well. It's something that you should have on your own. One point I would like to point out here is that if you have any disabled person in your family, it's nothing to be ashamed of. But you can claim certain tax exemptions on their name as well, in the sense that if they're a dependent, if they're disabled and they're dependent on you, then there's certain limits that you can claim in your taxation, that you can get exemptions. Sorry. While in the new tax regime, only if you are physically disabled, then under Section 80U, you can claim the benefits. Moving on to education loan. If anyone has an education loan, this is one avenue in the tax regime, the tax act, that has no limit. So even if you're paying, say, 5 lakhs as your interest on your education loan, that entire thing you can claim, but pay attention that it's only in the old tax regime and not the new tax regime. Retirement benefits, which has not been changed at all, that is then old and new. PF, gratuity, superannuation, something I've even covered above. So there's no implications on this because it's normally not taxable at all. Okay. Now in the next 3 slides, I'm going to show you, this is going to be helpful for you to understand where you are, what kind of options you have, like options in the sense that what do you normally do if you're paying rent, if you have a house loan, if you're using your ATC benefits, investing into all those ATC avenues, then which one should you I've put it very simple and black and white for you. Which one should you go for, old or new, right? So I'm going to request you all to just look at this this table. Before looking at the table, I would like you to look at the part on the right, saying that this table over here shows that you do normally save 1.5 lakh rupees under ATC. Okay, your ATC investments are 1.5 lakh rupees, which is the limit. And over and above that, this one table counts that either you're using your entire HRA of 2 lakh rupees approximately, or you're using your entire interest on housing loan. You're claiming that as an exemption. So in the old one, right, if your income is anything between 5 to 20 lakh rupees, it does make sense to stick to the old regime because of these two, the ATC and your HRA or your housing loan payments. Now, this is clear cut in front of you that, okay, if you have these habits of saving ATCs per year, as well as you're paying rent or you're having a home loan, simply just stick to the old regime because you're paying lesser tax over there. Then compared to the new one, if if you're not contributing into, or if you are contributing into these avenues, the ATC and HRA, but you won't be able to claim it, right? So then the new regime won't make sense for you, right? You might as well stick to the old one because in the new regime you'll pay more tax. Okay, I'm just going to leave this on here for another 10 seconds so you can have a look on your personal view. All right. So now coming to the next part, where you do not save. That means you do save in your ATC investments, be it your LICs, ULIPs, ELSS, PF contributions, whatever it is. So you're using only your ATC section of 1.5 lakh rupees, and you're not staying on rent. You're staying at home itself. You have your own property, and you have no loan as of now. So in that case, this is the table which would this is the taxation that would be there for you. So if your income is about, say, 10 lakh rupees, then the tax that you're going to pay in this case is going to be about 75,400, while that's in the old regime. While in the new regime, you're going to pay slightly higher of about 78,000 rupees. Now, if your income is about 20 lakh rupees, and you remember again, you're claiming only 1.5 lakhs as ATC, then it makes sense for you to go to the new tax regime because you'd be paying about 15,000 lesser. Everyone, I would like to just give you a pro tip over here for all those individuals that are staying with their parents, which it's about 70% of Indian population. So whoever's staying with their parents, and their parents, either mom or dad, who's the house it is on, the name of the house it's on, your mom or dad, you can show that you're paying rent to them. Okay, and obviously the money stays in the family. If their tax slabs are not high, it's their income is below 5 lakh rupees, then they won't, like, you're literally giving them money and you're reducing your tax liability. And be assured that this is completely legal. So staying in your parents' house, you can show that you're paying them rent, right? Which is obviously a good gesture also, because they've always supported us. And yeah, and then you can reduce your tax liability as well. Say, for example, like the previous example, 2 lakh rupees at least, you can reduce your tax liability. Okay, so in that case, then you will have to stick to the old one itself, because it will make a lot more sense tax-wise. Last but not the least, for those who do not have any interest in saving in your ATCs, who do not want to invest in those avenues, or who also don't want to, like, or who have houses of their own where they're not paying rent, or they're not paying an EMI with the interest they're not paying an EMI. In that case, for those individuals, it makes absolute sense to stick to the new regime if their income is anything above 6 lakh rupees. So that's the friction point, 6 lakh rupees for someone who's not investing into these avenues. You should change to the new tax regime. But the good part is, yeah, you can obviously switch back the next year whenever your income is going up and you decide to save. You can always switch back into it. until and unless you don't have any business income. Just to give a simple example of business income, even like if you're running a Uber service, like if you have a car and you just put it out on Uber, that's considered as a business income. Just to let you know. So if you have any questions about this, do note it down. I will be taking it at the end. To be honest, I'm going to try and get audio questions also, but then let's see how that goes. I'll have you raise your hands and things like that. So now I'm sure everyone is just confused about what's going on with the whole COVID-19 scenario, and if anyone has invested into the markets, their shares have bled a bit, but if they have invested back at the bottoms, then they have made a good 30% back as well within a span of like 2 months, which is amazing. But yes, it's a pretty confusing time to understand what's going on in the market. One thing to understand, of our Indian economy is that we're an emerging market, right? So we need higher numbers in terms of manufacturing, in terms of credit, like credit going out to uh, manufacturers in the industry also for it to boom, right? This helps us to grow our GDP. Okay. Now, in the last couple of months, we actually had a prediction of at least 6% growth in India, but due to this pandemic, our growth rate is about 2.1%, which, to be very honest, is still great compared to all other countries. India is actually the top two right now, which is promising in the growth wise, in the growth sector, because we still have a lot of potential in this country, right? But then again, like our main focus right now is completely, on it's not at all on the economic point of view, because we need to have everyone, alive rather to really get the economy moving. Because one unique thing about India is that our labor sector is like we have a lot of labor, so that it's our labor is cheap over here, right? And that's because of the numbers as well. But yes, this is something that the entire economy is not doing too well. Our projection from 6 has fallen down to 2.1, which is at little worse than China also as of now, and almost same as Indonesia. But yes, it's a global pandemic, and it's normal for any economy to not really do that well over here and go through some issues, and find its best ways to revive the economy, like to come back. um, yes, as I mentioned, manufacturing sector, that is taking a big hit because factories are closed. Only essential services are going to be allowed, which is good because we don't want this to spread more, understanding our the health infrastructure in India. So we can't really take that kind of risk to to do that. Okay. The government is trying to revive us, like revive the economy in total. They are giving a lot of attention rather to the small and medium enterprises, because they're the ones that really they're the ones that really suffer at these points, because they don't like they don't really sit on a lot of cash, so to say. And in times like this, when there's no income at all, but there's yet an outflow, so those are the like those the small and medium companies are the ones that really take a hit. And so the government is trying their best to really support the small and medium companies, enterprises, sorry. And like recently, the government announced about like they've just been throwing in stimuluses to boost this side of it. Um, One point which you will relate to is that if in the previous year, okay, I'm talking about financial year 1920, if you have not, you know, first of all, if you have decided if to go for the old regime, right, that means you have decided that okay, you have to invest 1.5 lakh rupees total in ATC and claim your HRAs and whatnot. So one good news is that if you haven't done that yet, right, you have time till June 30th to make your like investments, or get those things in line to save taxes over there. And I'll even talk a little bit about where you can invest, because there are a couple of opportunities in the most troubled times as well. As an advisor, I can help you out over there. Um, and yeah, as I mentioned, like the government is really trying to uh, help boost the economy. I'll try and get a little more talk about things that would really help you out personally rather than macro level. But one point which I would mention on macro level is that, see, there are three types of recoveries or scenarios that we can imagine, or we can predict rather, in happening to India. One is a V-shaped recovery. V-shape, as the syllable indicates, is just everything goes down, and then within it has a quick recovery as well. Now, this is something that, to be honest, in my personal opinion, we're past the stage. We do not see a very good. I don't see a very good V-shaped recovery, because the virus has not been contained completely. There's still, what, 40,000. Like, there's a lot of cases yet going on in India, and the lockdown also has been extended. So the V-shaped recovery is kind of out of the way, in my opinion. U-shaped recovery is something that is still on the table, so to say, because this, our lockdown, we have extended it for, this is what, the second month going on, so to say. It very much, like, in my personal opinion, I think it's going to be extended to June 15th at least, again, my opinion, until some, at least, a cure, or certain containment measures, like how countries, or like places like South Korea, they've really contained the places, or even a domestic example like Goa, like, all cases have been eradicated because they took care of it in time and they avoided the spread. So if that continues in the entire India, then we do see a lot of things opening, like how we saw yesterday. Private sector companies are allowed to open to 33% capacity. Worst case scenario is that there's no remedy in place. Everything has to be on lockdown for the next 3 to 6 months. Vaccine also, there's no, like, the vaccine is not strong enough, and like how, I don't know if it's true or not. Like, there were cases where, cases were re-emerging in China, like people who had the virus, got rid of it, and then again they were contracting it. So that's like the worst scenario, where it's an L-shaped recovery. Like, I wouldn't even call that a recovery, but then it's a slump. Like, it'll take a very long time for it to recover. Now, talking about different asset classes, where one second, where like, so in total there's really just four sectors or four avenues of investment in today's world. I would say five now, but let's stick to the basic four. One is equity. So equity wise, yes, I see that once things settle down, companies which have enough debt, like, debt equity ratio, they have enough cash to ride the wave of COVID, so to say. Those companies will persist. They'll prevail. I'm not. I cannot give you company names exactly, but the big companies which have good enough reserves to really get out of this scenario, those companies will definitely, post some good profits over a period of time. I always look at equity being long term, because, like, there's certain things that go into equity when the returns come in line. Like, just to give you a perspective, like how, let's look at the pharma sector, right? In equity, like, pharma has not been doing good since the past 3 to 4 years, but now all of a sudden there's a boom in it, right? So equity takes time, right? There's a lot of compounding that really increases your money. And in this, if I would suggest anything, I would suggest two things. One would be to stay a little bit out of the small and mid companies. Well, mid is still okay, but specifically the small companies where they're running through a lot of problems. As a say a beginner or an investor who in the beginning phases, who doesn't give it too much time into it, I would stay out of the small cap funds, because the risk is slightly higher there. And if you are investing monthly, guys, I know times are a little different, that times are uncertain, but come on, your expenses have reduced. Don't think about stopping your SIPs, because now, just look at the numbers in the last 2 months. Rather, you have bought the same equity shares at a way cheaper price. So this is not the time to really stop your SIPs. but just make sure you're investing in the right place. As simple as that. Speaking about debt, the second category of investment, yes, fixed deposits for short-term goals. Short-term, I mean 1 to 2 years. Definitely, it's the perfect avenue. You can probably get in touch with us to to help you make it tax efficient. It has no volatility. Everyone knows about what do you call it, fixed deposits. So one thing that I would suggest for those going for shorter term investments, say 6 months, 8 months, they want to invest it on that term. You can look at some liquid funds as well in mutual funds. They're relatively short. Um, what do you call it? But sometimes they do give negative returns, like how if you see, if I don't know if everyone has read about the whole Templeton just stopping about 6 funds of theirs. The reason is because if the redemption pressure comes, people want their money back, then they won't be able to sell those papers that they have. So you need to take a call as to speak with your financial advisor where you can put your money depending upon your time horizon as well as your risk appetite. Gold, yes, gold is always something that you can hedge your risk with. I believe if in your total portfolio at least 5 to 10% should be in gold itself, not more, not less. But again, it depends on your risk appetite. If you want lesser risk, you can increase your amount. The way that you can go for it is through RBI SOV bonds, and yeah, and they give about 2.5% fixed returns also over and above the appreciation. Real estate, guys, real estate is something that is, amongst it's taken a big hit. It's taken a very big hit to because no one wants to make those what do you call it, big investments as of now, understanding that there's uncertainty. We don't know after 6 months if things go south. I don't even know if I have a job, so I don't want to take a huge EMI of a lakh or like 80,000 per month. I don't. No one is ready to take that. So that's why real estate is something like my opinion is negative. Plus, in real estate, like the whole supply of it, in the sense that the construction of it also would see a huge slowdown because builders also they are facing a little bit of cash crunch. It has been like this for some time. In fact, for a couple of years as of now. Last but not the least, insurance. Guys, I think this is the best time to really look into your personal financial health to see that if you're covered enough or not. I kid you not. One of my clients called me and he's like, I haven't thought about this in 15 years. But then now I see that I should have thought about this before because you would have made so many changes over a period of time. Like something maybe that everyone can relate to is that, like, how if you use, say, Airtel or Vodafone, if you've taken a scheme, say, 5 years back, and you're still on that scheme, it's probably really outdated, right? And the things that come out new are way cheaper and way more beneficial, right? So you just need to have a look at it again, ensure that you're covered enough. And I would definitely suggest to cover yourself over and above your company because, come on, like, it's you never know what happens tomorrow. Is it enough? Is it not enough? Over and above, you need to take it. It's as simple as that. So the point of this slide was that don't put all your eggs in one basket. Just make sure you diversify and put it into different areas. Um, Speaking about sectors, in total, the like as I mentioned, real estate. Yes, this is not a really good time about it for it because of the reasons I mentioned. Aviation is an industry which has been hit the most because lockdown restrictions. There's been very bad sentiments also for people out of not forget about India. India there's no aviation right now, and it's just been locked down all around the world. Also, there's so many companies that have actually shut down. They're stopping their services because everyone has this whole negative environment about traveling to places, and the health impact about it. Oil and gas, yes, there has been a very big issue about um, the prices, so to say, of crude. But over a period of time, you will see a little bit of recovery in this sector because the demand will go up shortly. But I feel that oil and gas is somewhat a sunset industry in a way that and just to counter, like the other sunrise industry is more like, electric vehicles and things that can be operated through natural ways. Banking and insurance, well, see, if any economy wants to move, banking is something that it needs. As simple as that. Specifically in like an emerging economy, banking is definitely needed. Like how, the one way how this government is passing on the, stimulus, as in the help that they're passing on to the lower, um, lower income groups is, thankfully, a few years back, they had made all the other cards in their bank accounts and they can transfer it through that itself. Insurance, I think insurance is something that is going to take a very big boom, because in the era that we're living in, compared to before, I know as of today, it's, death is something that has increased, but comparatively, it's one of the safest times in the world, keeping aside coronavirus. But as once the this sector, like, sorry, once the coronavirus part is taken care of, it's going to go back into a good zone. Automotive, so that's automobile and auto ancillaries. That's also one sector that's going to, take a very big hit, because it's a non-discretionary product. When I say non-discretionary, I mean that if I had decided before to buy a car, say in April, I would definitely postpone that, say, maybe till November, for all I know. It's something that I can, postpone. So that entire industry is, it's in trouble, so to say. So yeah, and then now we're looking, as I mentioned, pharma, healthcare. Yes, there's a lot of positive impact of coronavirus in today's term, because yeah, we realize that we've not given it too much attention. The whole healthcare infra, like if you go to see, Italy is the second best uh, country when it comes to health infra, right? And with the number of deaths over there going up, almost 30,000 deaths incurring over there, we clearly see signs that, yeah, we need to spend a lot more on research and development and really take care of the entire health infra of this world. FMCG is fast moving consumer goods. Yes, positive opinion, because it's is few factories are yet open, about essential factories rather, they're open. People are going to consume more sitting at home. Sometimes bulk buying also is going to be there. Um, yeah, coming to information technology, guys, I see a huge transformation rather of companies going into IT. Reason being is that because you're seeing that, okay, you can do this, you can get this job done at work, at home as well. So companies will think about, why am I spending so much on this infra? Like, let's take Bombay for example. The rent of here is like, it's not normal, right? Companies like TCS, they've already declared that 75% of their employees are going to work from home. So IT is something that I do see a lot of potential in. Um, Mining and metal, I wouldn't want to comment on it too much. I do have a negative opinion about it, but I'm not going to comment too much on this. Consumer durables, because it's a negative impact, because you can always postpone buying a TV. It's not important at all right now. So guys, now just to give you a little bit of, adding value to you, there's six main things that I want to talk about. Like, one, you really need to have an emergency corpus at any point of time, right? This is between 3 to 6 months of your expenses. Because you never know who, like, this is not a personal comment over here. I'm just telling you from a general perspective that, see, you never know tomorrow if either, maybe you get unemployed or whatever it is. Your EMIs are still going to be there. Your children's education funds are, like, you're going to have to contribute towards them. Your expenses are going to be, you can't just stop eating, right? So you should have, or even there's a medical emergency that's required, which, you don't have enough cover of. So you need to have at least 3 to 6 months of your expenses in line. Um, your outflows need to be, watched out for. To be honest, I wouldn't even comment too much on this, because I've seen the culture in India over here. We are a savings nation. We don't, like, this has been passed on from generations, even though it's it's fading a little bit, but it's yet there prominently, at least 60-70%. Just watch out for the expenses. Don't spend on luxury things right now, at least. Yeah. And SIPs, yes, please continue with your SIPs. You're going to make a lot of money over a period of time. Just find the right companies to invest into, or find the right financial advisor. Review your portfolio. If you have a financial plan in line, review your portfolio, or your portfolio, just review it, see the sectors that you've invested into, and make changes accordingly. Try your best to stay out of futures and options. Like, just it's too volatile right now to think about it. um, Last but not the least, hang in there. This is like, the world has seen this before as well. um, Yeah, and just another fact about us is that we have this app as well. It's called Minty. Um, whatever doubts, whatever questions that you do have, you can just log into our, download our app, log into it, and yeah, we have experts there to really answer your question. This is not like, Quora or something, that you can expect the answer later. We respond to it pretty fast, be it for tax planning, be it whatever it is. Your questions are there, you can be answered with us. And yeah, that's about it for me. So Manoj, I would, and anyone, any questions and all, please feel free uh, to ask.
Thank you, Lavish. Thank you so much. This seems to be very wonderful. Again, at the same point of time, I am glad to take down any questions that the audience might have. We do have a couple of questions that have come across. I'm sure you'll be able to answer those. There is one question. If we are paying housing loan and we have taken 24B tax benefit, can we
Mhm.
also claim the HRA in that case? Lavish, your
Well, okay. So if this question would, like, see, if you're staying in your own house property, right, and then obviously you cannot claim HRA. But if you are taking, like, your housing loan is of a different property, say it's let out as well, and also that you're staying on rent, yes, you can take both these benefits. Yeah, so yeah, the answer is yes. If you are staying in another property, like you're staying on rent, as well as the property that you own, that you're taking 24B as your housing loan interest that you're paying, it's a different property. Either you've let it out, or it's deemed let out. You can take both the benefits.
thank you. Thank you. There is another question, a very interesting one. How do you select mutual fund? And if the investment horizon is for approximately 10 to 15 years, how do you go about it? Ravish, your take?
So the two very basic principles whenever you want to invest into equity. Okay, I'll break it down for you very simple. Number one is that figure out your time horizon, which you have aptly, like you rightly said, you have a good 10-15 years, which is great. So first of all, equity, yes, that is an asset class you should consider. Number two, you need to understand your risk appetite, or to put it in simpler terms, you need to define what kind of returns you want. Okay, so I'll give you, like, if you are looking at, you're comfortable between 10 to 12% returns, right? Then just simply stick to the large cap funds, all the giant large cap funds, just stick to them. Okay, if you're like, okay, my risk capital is higher and I want higher returns, so if that would mean that I'm expecting returns between 12 to 15%, then, sorry, 13 to 15%, whatever, then stick to mid cap companies, right? Similarly, if you have high risk and you want high returns, you want 15 to 18, 20% returns, then you can go to the smaller cap companies. So in mutual funds also, you have these asset classes, or rather you have these funds would give you exposure to these particular asset classes. So yeah.
Thank you. Uh, okay, there is another question. What would be the default regime for a salaried person whose CTC is up to 5 to 6 lakhs? So, is there a default regime that means if a person is falling into a salary bracket of 5 to 6 lakh that he has to choose an the old tax regime, or can he go for the new tax regime?
So as we mentioned, there's no default. Like default is going to be your old tax regime itself. If you don't make any changes or if you don't tell the HR that you want to change, so that's going to be there itself. But if you're earning 5 lakh rupees, there's no difference anyway, because the tax slab wise, if I showed you over here, so if you go to see between 2.5 to 5 lakh rupees, it's anyways nil tax. So yeah, anything. So just to add a little more to your question, the slide that you're looking at. What's as I mentioned. So your threshold limit is like six. If your income is above 6 lakh rupees, then and you're not contributing to anything. Like if you're not making those investments and all or HRA whatever, then go to the new. Or else if you're doing those investments, then you can stick to the old accordingly.
Thank you. And how beneficial would it be to invest in NPS at this point of time? Your take, please.
Yes, just do it. Because you're saving taxes. Number one, if you're if you're in 30% bracket, you're saving 15,000 rupees over there. Number one. Number two, you are getting a return on investment as well. So if you go to see, just look at the returns of NPS, then you can take a call as well if you're comfortable with it. And yeah, I think that's a solid yes for me.
Thank you. There's another question. The person is investing in mid cap, growth fund, and large cap also. So, does he need to change anything or let it continue in the SIPs? Currently,
So
everything is showing the entire portfolio is showing is negative growth. So, what
sorry,
do you
Manoj, can you
suggest your
repeat
take?
that? I couldn't catch the beginning.
Yeah, the person is investing into mid cap, growth fund, and large cap. And at this point of time, his portfolio shows high negative, high negatives. So does he need to change it or let the SIPs be rolling? Should he pause it? What would you suggest?
So I believe I've already answered this question. Continue, man. Like just continue your SIPs right now because you're literally getting at, you're getting it at a sale price. Like you're getting at a discounted price right now. Um, Again, if you, like you have to look at the criteria of your investments and your horizon as well. Mid cap companies usually give higher returns as well as higher losses, in times like this. And the entire world is bleeding right now in terms of returns. So you're not alone, and people continuing their SIPs also are not alone. Like it's a good time to continue,
Thank
unless
you.
like you need the
Yeah.
money in the next shorter term period. Then that's a different ball game.
Thank you. I'll take a few more questions.
Mm-hmm.
If any corporate employee in mid-level salary package of 10 to 15 lakhs and he's having all his exemption deduction available with him, so for such an employee, what is your suggestion? Should
Old
he
tax
go
regime.
for a new tax regime or the old tax regime? What would you suggest?
Old tax regime. Simple. I think I've already answered that question
Okay.
as to why.
Okay. And what sectors are likely to do well in the next 2 years? Your take, in case if you can share some
So
insights.
I think I covered that sector part over here as well. Guys, three things: IT, pharma, FMCG. These ones are what I'm bullish on. Yeah.
Okay, thank you. We are ready to take few more questions. In case if you have any questions, there is another question. If you have savings only like LIC, VPF, and NPS, and also claiming HRA, would it be better the old one or the new one? Salary is greater than 20 lakhs per annum.
Old.
Old one.
Yeah, because so now in the old regime, you're claiming up to 1.5 lakh rupees as well as 50, so 2 lakh rupees as a tax deduction. And so in this case, you'll have to see like if the person has, what do you call it, the housing loan or any HRA that he can claim as well, then clearly old. Even if not, then old would be relatively better.
Thank you. And how cautious should one be in terms of debt fund exposure? With this, the current panic situation in debt segment, to be very honest. So, what would your take would be at this
I would,
point of time?
I would say be very cautious because if like right now companies will not disclose if they can really finance their debt or not right now. Many companies are trying to restructure it. Um, Debt, as per companies' debt, NCDs, corporate fixed deposit of smaller companies, even smaller banks, they're going, bust. So it is something that you need to be cautious about. There's no doubt about it. Unless if you want debt exposure, go for government bonds. They are like 7.1% taxable bonds from RBI, or what if you have a long, like, for example, if you're at the age of, let's talk about age of say 40, 45, right? You know for a fact that you have a good 10, 15 years as 50, or rather 15, 20 years, whatever, of working life, and you want to you want to increase your debt exposure over a period of time, right, till you retire. So go into, like, many insurance companies, they provide you long-term debts. They give you 15 years debt, 20 years debt, and they fix the percentage from you today. Why I'm saying this is because insurance companies cannot go bankrupt. If they do want to exit the market, they have to pass their entire assets or and liabilities to another company. So, and obviously, these insurance companies also, depending upon which product you're buying, I'm talking about a pure traditional product where they give you guaranteed returns. You're sticking with, they give you a guaranteed 5%, 6% for the next 20, 30 years, tax free. So, when you're retiring, right? So, when at the age of 55, 60, 65, when you need those debt products, right? At that point, you have something already in line which you've been, watering, rather, like you've been funding all your working life, and they're giving you, income when you need it the most.
Okay, thank you. One more question that we have. Can you give a diversification of investment given, in percentage? I mean to say, if somebody wants to diversify his portfolio, so what would your what would be your percentage be? Probably
Cool.
10% in
So,
gold, 20% in shares, or probably
right,
equity. How would you
right.
diversify that? Could you give
So
a take on it?
now I'm gonna give a little bit of assumptions before I give a breakdown. So let's assume someone who is, say, 35 years old. Okay, someone's 35 years old. He um, he has, a few goals of his, say, after, um, be it after 10, 12 years of, of the child's education or whatever, as well as he has his retirement to take care of. So this person, I would tell him to put about, 5-10% into gold, right? At least 50 to 60% into equity, keeping in mind that his goals are not very short term. Like, he doesn't have any major goals that he's saving for in the next, say, 3-5 years. So 50%, 50 to 60% into equity. So that's total 70%. 30% I would put into debt as of now. Then again, is a different scenario when a person has, real estate exposure also. Then things change a little bit. You'll have to, eat into your equity savings as well as debt savings.
Thank
So yeah.
you. Yeah. Another question regarding the moratorium period, which is provided by the bank for the EMIs. So, would you suggest taking the EMI moratorium, or would you actually go ahead and tell the person, if you have enough available cash, please pay off those loans? Do not take the moratorium. What is your take on it?
So let's understand what is a moratorium, right? Moratorium basically means that you are not liable to pay your EMIs for the next 3 months, but that same EMI is going to, be demanded from the 3 months after that. So this is just postponing your dues, right? So in this case, one should think, if one, if you have a salary cut and you're having a tough time adjusting to your expenses, EMIs and all, sure, you can take this option of taking a deferment of payment. Second option is that if everything you can yet manage it, don't take a postponement, because look, it's going to come back later on, or you're just postponing your payment. So if you can manage your cash flows, I would definitely suggest to continue paying for it.
Thank you. And in the same financial year, can we switch 2 to 3 times between the old to new and new to old? Is that a possibility,
So
Lavish?
there's only one time that you really um, that it's like when you file your returns, that's when you come to know how much tax you're paying, right? In between, like, in fact, it depends on your HR also, but then it's you can't do that because at the end of it, whatever tax that you're actually liable for, be it an old or new, you have to pay that. So no.
Okay. Okay, that's all questions that we had today for the day. I think we
Great.
have answered major of the questions. So thank you once again to all the attendees of the webinar. We were really happy in answering all the questions that you had, and we'll be more than happy to assist you with any furthermore questions. Please download the Minty application as suggested by Lavish. It's one-stop solution for all your tax and finance related queries. Plus, the recording of this webinar will also be available in our knowledge base in this application. So in case if any of your colleagues have missed out on this, the recording will soon be available in the next 24 to 48 hours. So do download it, and we'd be happy to take any questions that you may have related to the tax or financial that you may have. So once again, thank you so much for attending the webinar. We hope that we could serve you the next time around, and I'm sure you will find this fruitful as well. So on behalf of Financial Hospital, I would like to now take your leave. You do have a happy day. Thank you so much, Lavish, for providing your insights.
Thank
Have a
you.
good day.
Thanks. Thanks.